Hello, my name is Jay McCabe and I'm a commercial banker with Comerica Bank, and this is Ask the Banker. In this episode, I'll give you my take on the question, what financial ratios are most important to a bank? I'll be answering the question primarily for mid-sized companies with annual revenues of about 30 to 500 million. With that said, I think my answer will have applicability to companies of all sizes. Financial ratios provide critical insights into the health of your company. As a business owner, it's likely that you're already monitoring several ratios. The bank will take a similar approach, but with a more specific focus on your ability to repay a loan. These ratios will be translated into your loan agreement in the form of financial covenants. When you think of financial ratios that are important to a bank, think of financial covenants. While covenants are highly customized for each situation, from a high level, the bank will want ratios to cover three key areas. These are liquidity, leverage, and earnings or cash flow. To monitor liquidity, a bank might have a current ratio or quick ratio. The current ratio is simply current assets over current liabilities. The quick ratio is slightly more conservative, measuring only highly liquid current assets such as cash and accounts receivable over current liabilities. If your company only needs a line of credit, another alternative to these covenants is for the bank to use a borrowing-based formula which governs advances on the line based on a percentage of accounts receivable and inventory. To monitor leverage, a bank might employ a balance sheet or cash flow leverage covenant. Balance sheet leverage, calculated as total liabilities over equity, shows how a company has financed its asset base. This ratio is probably more common for companies that only have a line of credit. Cash flow leverage, calculated as either bank debt or total debt over EBITDA, is more common for larger companies with term debt facilities or multi-year lines of credit. Cash flow leverage also provides an indication of how many years it might take to repay a loan. To monitor earnings or cash flow and ensure adequate coverage of debt payments, a bank might use a fixed charge coverage ratio or minimum profitability threshold. The fixed charge coverage ratio is generally calculated as free cash flow over principal and interest. Minimum profitability is more commonly used for companies that only have a line of credit, which requires interest payments only. Here are a couple things to keep in mind when it comes to financial covenants. They are designed to be an early warning system for the bank. Should your company not meet the covenants outlined in the loan agreement, this represents a default and allows the bank to take legal action. From a practical standpoint, the bank can hit the pause button to better understand the situation and determine the right next step. Covenants should be a win-win, allowing you to operate your business in a productive manner. Think of covenants as buoys in a harbor. If a ship doesn't hit a buoy, it won't hit the rocks either. Communication is key. If you think there's a good chance that you will not meet a financial covenant, let your banker know as soon as possible. This will show that you are monitoring the key aspects of your banking relationship, and it will allow your banker to advocate for your business and coordinate with key stakeholders within the bank. I hope you found some value in this video. If you have any questions, please write them in the comments or send me a direct message. My name is Jay McCabe, and I'm a commercial banker with Comerica Bank, and this is Ask the Banker.